Okay, so I'm saying we are looking at performance measurement. And performance measurement entails three main things. One, the return on investment. The second one is residual income. And the third one is economic value-added statements. So we will again go back to the past papers and attempt to solve some questions. The first one is on page 174. That is a question that was tested in July 2000 as question 3A. Question of July 2000, question 3A. In our past papers, it is on page 174. Page 174. And the question says that the Z division of XYZ Limited produces a component which it sells externally and can also be transferred to other divisions within the organization. The division has set a performance target for the coming financial year of residual income of 5 million. The following budgeted information relating to said division has been prepared for the coming financial year. Maximum production stroke sales capacity is 800,000 units. Sales to external customers, 500,000 units at 37. Variable cost per component at shillings 25. A fixed cost directly attributable to the division, 1.4 million. Capital employed, 20 million with a cost of capital of 13%. The X division of XYZ Limited has asked Z division to quote a transfer price for units of the component. Now you are required to calculate the transfer price per component, which Z division should quote to X division so that its residual income target is achieved. So the first thing is to write the formula of residual income. Residual income is given as divisional contribution. Divisional contribution minus the cost of capital. Minus the cost of capital. The cost of capital. And from our CVP, we know when we mention the word contribution is the difference between the price and variable costs. But when it comes to the residual income, this contribution includes the specific fixed costs. By that I mean the fixed cost that can be clearly identified with the department or the division. So as such then, we will need to say that the residual income that is desired is 5 million. Should be equal to, for us to get contribution, it must be revenue. Now revenue, in this case where there is a transfer price, you know, in transfer pricing contexts, we have two types of revenues. We normally have the external revenue and also the internal revenue. So the external is what you're selling to the outsiders. This division, to the outsiders, they are selling 500,000 units at a selling price of 37. That is according to information 2. And we are also told that their total production stroke sales capacity is 800, according to information 1. It then follows that internally, they are transferring 300,000 units at a transfer price that we do not know. At a transfer price that we do not know. That is the revenue. Then we seek to less the costs. We less the costs. The costs are the variable costs. We will have the 800,000 or the units. The variable cost is 25 according to information 3, 25. Then we minus the fixed cost directly attributable. Directly attributable. Those are the ones I was calling the specific. Is 1.4 million. Now, if you were to stop at that point, that is now what we are calling the divisional contribution. Then you less the cost of capital. And the cost of capital, we are told, it is 13% of 20 million. It is 13% of 20 million. So I want to now the 300. Good. Tumesema they are producing 800. Then externally wanauza. So hiyo ingine inaenda wapi? Internal transfer. So that this plus this. So you solve and tell me transfer price is what? So online, also said your answers. Transfer price is 35. Someone else to confirm. We have certificate. Matter 70.
Yeah.
These things, you can just put everything in the calculator and get the answer straight. But for the interest of this day being a good morning, who multiply easy? No, these times this. 18 million. 18,500,000. Plus 300,000 transfer price. Minus this one, 20 million. Minus 1.4. Minus 2.6 million. So these things become very simple like this. So you put the right terms together. So hii kikipia huku inakuwa minus 18,500. Huyu akikipia huko anakuwa plus. Huyu anakuwa plus. Hata huyu ni plus. Ndio this side tukue tumeachiwa 300,000 transfer price. Sasa hii nipatie 10,500,000 is equal to 300,000 transfer price. And therefore, if you say 10,500, you divide by 300,000 is the transfer price. Is this the one giving you 35? Sasa kama unalemewa kusoma ikiwa imepangwa anapanga. Kama unapanga inaila utasoma. So the transfer price is 35. Confirm. So the next question is asking, now. Inasema? Explain why. From the point of view of X, Y, and Z. Thank you. So you are asked to tell us why this one can lead to suboptimal decision making. So we need to say what is suboptimality. So I think I mean suboptimal decision making. Suboptimal decision making is about making decisions. Is about making decisions for own good. For own good. Even when it is at the expense of the others. Even when it is at the expense of the others. First of all, the transfer price of 95 shillings. The transfer price of 95 shillings can easily make the manager of the supplying division, to make suboptimal decisions. This is because the price reduces his profit by 2 shillings per unit. The price reduces his profit by 2 shillings per unit. And a total of 600,000 shillings. First of all, the reduced profit will affect his performance measurement adversely. A possible suboptimal decision is to produce the intermediate product. At a cost of 23 shillings. The cost of 23 shillings. The effect is that the company will lose out the external market. Since the final product will be of poor quality. You should remember when we covered transfer pricing, especially the one require functions. When we came to optimize for the division, we noted that the overall profit of the company was coming down. That is what happens. If you're working as a team and you become so faithful to your own interests as opposed to the interest of the group, the end result is that in the short run you benefit, but in the long run, everyone loses, including yourself. Pursuit of selfish interests. Now, in this case, this supply manager has been requested or required from whichever quarters to transfer at 35, while he has external demand which he could sell at what? 37. So for every single unit he transfers internally, he's losing 2 shillings. So at the end of that deal, he will have lost how much? 600,000. And 600,000 is not a small amount of money. So assume that the targets that were set in the company were that he must hit a return, a residual income of 5.6. Now, courtesy of this transfer price, he will be found below. When they do the variance for him, he will report a 0.6 advance of just completed variances. And when you report an advance, the immediate action is that you should be punished. Now, no one would want or would welcome any punishment that is coming your way because of factors that were not as a result of your own actions, but factors that were brought by other people. So you must get a way of protecting yourself. So how do you protect yourself? One of the immediate measures is that you see here, he's making all the units at what? 25. So he can separate them, aseme hii yenye mnanibaia at 35. Na mimi nitawatengenezea at what? 23. So that the two sharings which mmeninyang'ania hapa na mimi ni wanyang'anya hapa, and the whole equation balances. So him, you will still report 5.6. But the end result is that you will have given to the other department a raw quality product. So when this product finally goes to the external market, it will lose out. And when the company loses the market, then everyone becomes a loser. And you know, when you're dealing with human beings or any organism, I've come to realize God gave everyone and everything defense mechanism. I don't know whether you know that. It's true. Everyone and everything, they have a defense mechanism. Hata kama unaona ako very weak, ama ni kadogo sana, somehow they will look around and they will get a way of defending themselves. So huyu mtu mtamfinya kidogo, but within no time, najikakamua and you stand now. So that is what should happen. And because we saw that you may not always transfer at a higher price, the way out is you call these managers and you tell them, we are aware that you will lose this. But when it comes to performance measurement, this one will not be fully recognized. Or you will not be punished because of this. Now, when you tell me how to niadibu, then I will still proceed. Or when you tell me that I will still enjoy the benefits that come because of this, then I will have no problem. But whereas in Nyanganya, then at the end of the day, you can't punish me. I will have to defend myself in the long run. So that is the explanation. From there, let us go to this question that is on page 159. It is a question that was tested in May 2002 as question 5. May 2002 as question 5. It's on page 159. I suggest you read on your own as I design a summary. Shamaliza kusoma, you copy the table. I will have finished the design. So we can have a table like that to summarize everything. And we are doing for the 2001. So the first division inaitwa newspapers. Hiyo ingine inaitwa television. Hiyo mwingine inaitwa film studios. Then they are mentioning of a new project. Let me just call it new project. New project. So design a table that way. But hii mambo ya kupanga, you should not give the order in the exam. You can do one at a time. Shaipanga, it looks nice, and it also saves on energy and time.
For residual income, the formula for income is the same as capital employees.
Capital? The formula is what?
Is another formula for
the formula is the same, but you could use different names. Like right now in this lesson, I've already used 2 names. If you are keen. Have you noted that? Sio swali tumejibu ya kwanza ilikuwa residual income. Did we write the formula? Actually, that's what I wanted. I expected you to ask the very fast thing. Bona formula in the but it's basically the same thing. It's only that people use different terms. Yes. But it's the same thing. As in the profit that is identifiable with that part. Okay. So I believe now we are all there. So if we are there, let's start with the newspapers. The income in the newspaper is 1,100. So we are going to have 1,100. You divide by the revenue of 4,600. Maybe you can give me to 2 decimals. .24. We go to television. Television income is 160. Income is 160. And the assets invested or the revenue is 6,400. 6,400. .03. And then we go to film studios. The income is 200. You divide by the revenue of 16. 0.12. Now for the new project, once we get there, we shall come back where necessary because it may not have everything. If we had space or if we had been told to rank, in the Weka ranking here, and these are ratios, and I normally find many people having problems with ratios. Remember, a ratio is interpreted as 1:n. And 1 is the denominator, the value in the denominator. And n is the value in the numerator. Like now, this ratio here, I should have written it as 1 is to 0.24. That is how it should have been written. But as you know, we rarely or we don't keep on writing what? 1. Just like when you are told 3 times 1 is 3. We just write 3. We don't keep on writing 1. I've already said this represents the denominator, and this represents the numerator. If you look at our formula here, then our revenue is the denominator, and our numerator is the income. If you are told to explain what this means, it means for everyone sharing of revenue, you have 0.24 income. Or if you want to look at it in percentages or in terms of 100 so that we remove the decimal, For every 100 shillings of sales you make, therein you have a profit of 24 shillings. Is that okay? Yeah. I'm insisting on that because najua tukifika kwa hiva na watu wanaanza kuniambia how are we getting that? We need to know how to interpret ratios. For every 1 shilling of sales, this is the profit that you are making. So if you are told now to rank those 3 departments, which one is better? Newspapers is better because for every 1 shilling, inatupea 0.24. So amefuatwa na huyu, amefuatwa na huyu. This one is doing so poor. This is the same margin that we were using when we were in price. The profit margin, profit out of price. Let's go to turnover. We do the same. We do the same with so turnover, you take the revenue, 4,600. The assets, again, when you see the word assets, it is the other word for capital. And when we talk of capital, it is all the liabilities except the current liabilities. Except the current liabilities. So hata hivi tutaona ikibadilika as we go to other questions. But it's the same thing. The same thing. So here they have given it a very clear name, assets. So newspapers, the assets are 4,900. Give me the answer. $0.94. Let's confine ourselves to decimals. Then huyu mwingine is a revenue of 6,400 and an asset base of 3,000. An asset base of 3,000, 2.13. Yes, Lydia, I can see your answer. This other one, the revenue is 1,650. And the asset base is 2,600. 0.64. Yeah, 0.63. So again, the meaning of this, because the denominator is the assets and the numerator is the revenue. Inamaanisha, for every 1 shilling you invest in an asset, that shilling is helping you generate a revenue of 0.94. Hapa kwa TV, it is helping you generate a revenue of 2.13. Na hapa inakuletea 0.63. So your shilling should be invested where? In the television. If you are making decision purely based on capital turnover. That's the meaning. Okay, then we come to the return on investment. So the return on investment, this will be 0.24 times 0.94 times 100. $22.56%. Hapa with 0.03 times 2.13 times 100. Six points. 6.39. And this other one is 0.12 times 0.63. 7.56. If you are keen, you'll be able to see that this formula, this return on investment, we can collapse it to just two things: income over assets. You see that? This times this. Have you seen that? The revenue will cancel out. So the other way of writing the formula for return on investment is simply income over what? Assets. Hiyo ndio tutakuwa tunatumia sana. Assets and yes, the capital. Less current liabilities. Yeah, you can also call it capital employed. If you're in finance or if you're in a farm, you just call it capital. But they are one and the same thing. The beauty with the MA is that it's very rich with very many words that mean the same thing. That's the beauty. No. It depends on how you look at it. Some of us, the beauty. When you have a variety, it is beautiful. It is good. It's just like this class. Now that you are many, it is good compared to when I'm teaching one student. Yes. Okay. But the same interpretation can go here and not go there. Yes. Let me clarify on that. Because many will either say, "Must to return one next week." Now, the other thing that I wanted to point out, because this topic, other than the exam, it's very practical in life. It's very practical in life. So I keep on insisting about it. One of the things you can see here is that when you're making decisions, it's always advisable you include as many factors as possible. You talk to as many people as possible before you settle on a decision. If you just talk to one person called Martin, he would have told you to go for 0.24. But at the end of what you go for, you profit. So you make a return of what? 22. Which means you still have done the right thing. Because when you rate these three projects or these three divisions on the basis of ROI, this emerges the best. You see that? But if you consulted a person called capital turnover, he would have advised you to go for this one. Now, in that case, you can see end result you seriously lose because you are getting 6 where you could have gotten what? 22. So, if you just rely on this, well and good. But remember, in decision making, we are usually told we hope for the best, but prepare for the worst. So we are fearful of using these alone. That's why you are advised to use both, so that you settle here and combine it. The other question that we can be able to ask is, if the two finally give us the same answer, why do we both are going through these two? The reason is, it is good to understand both, because both come because of different factors, and their sustainabilities are also different. Now, this one is short term, and this one is very visible. But this one is long term and usually not very visible. It is a concept which, in life, we say what we call the conspicuous spending vis-a-vis prosperity. Conspicuous spending and prosperity. Conspicuous spending is where you live a life that is so prominent inaonekana. The kind of the car you drive, ukipita kila mtu anapituka kuangalia. Unajua kuna magari ikipita tunaangalia, na kuna magari mengine hata ikipita unauliza itapita saa ngapi wewe. So you are driving those cars that ukipita mahali watu wanaangalia. where you live, the estate, ukiambia marafiki zako where you live wanashangaa because kulingana na wao miaka yako haijafika kuishi that area. Even the dressing, when you unavaa, the kind of all those kind of things, they are conspicuous. But prosperity at times is too quiet. Like mtu amenunua ka plot, like sasa hii tukikaa hivi, unaweza sema nani ako na plot mahali. And you'll be able to tell who has $1 million in the bank and who has zero. And you'll be able to tell who has what. So this one is quiet. But ukiangalia mavazi yetu venye tumevaa, you don't have to go anywhere. You can be able to tell hii ni pesa hii ni pesa hii. So hiyo ndio hii match. And the assets is here. Now, you need both. If you pay attention to this one more, you are likely to lose the same thing here. So you need to do a balance so that you don't go too far or too low or too slow to in either. Okay. The other thing that we need to compute is the residual income. So this one will be the income of 1100 minus the cost of capital. The cost of capital is what? Is 12%. You can see the required rate of return. 12%. So 0.12 times the assets. The assets are 4,900. Five, 12. Hii ingine ni 160 minus 12% of 3,000. Negative 200. Then again 200 minus 0.12 times 2,600. Minus 112, right? Yeah. So again, in terms of the profit in tobacco share by your capital providers, newspapers still emerge the best. Newspapers still emerge the best. So when we focus now on the project, they are saying, Jay Kanyama, manager of the newspaper division, is considering a proposal to invest 200 million in a fast speed printing process with the car options. The estimated increment to the year 2002 operating income would be 30. Yeah. So, tukikuja hapa kwa new projects, we don't know the revenue. We don't know the revenue. So that one, we can only compute return on investment, whereby we say it is the income of 30, you divide by the investment of 200, that's the asset, times 100. To do a return on investment is what percent? Hmm? 15%. Then tukikuja kwa residual income, utasema ni 30 minus 0.12 times 200. Six. So below that now, appraisal decision. Appraisal decision. Appraisal decision. So point number one. Point number one. When using return on investment method, when using return on investment method, the new project should be rejected. When using return on investment method, the new project should be rejected. Since it has a lower rate of return, since it has a lower rate of return than the existing divisional rate of return. Divisional rate of return. That is 15% is less than 22.56%. That is 15% is less than. Point number two. When using residual income method, residual income method, the new project should be accepted. The new project should be accepted. Because the rate of return is higher than. The rate of return is higher than the minimum required return. Is higher than the minimum required return. That is 15% is greater than 12%. 15% is greater than 12%. So what you're saying is if you are appraising from your FM, you know the various appraisal methods. Kina NPV, Kina profitability index, and so on. Right? So even these two are also appraisal methods that we use. According to this method, you should only accept a new project if it is coming with a higher rate of return than what you already have. So in the newspapers, we already have what? 22. So any new project that comes should be something giving us more than this. But if it gives us anything less than this, it should be rejected. That's why we are saying this new project should be rejected because you see it's giving us 15. I don't have time to show you how it will destroy value if you have to accept it. According to the residual income, you should only accept a project if the return on investment, is greater than the required rate of return. So this one satisfies that because you can see 15 is greater than And because of that, it is giving us a residual of what? 6. So one thing that comes out clear, and you shouldn't be able to question that, is how comes the same project is accepted and rejected by the 2 methods. So which method is right, or what is the true position? Both methods are right. And the true position depends on what you want. We normally say where you stand, or where you sit is where you stand. Naona hapo umeketi. Kaambia usimame utasimama hapo. Let me bring it closer to you. We are in a political season where political or party headquarters have been very busy. Today we have received. Now, those who are received, they are coming from somewhere and they are going somewhere. When they are on this side, they are angels. When they go to this other side, they are thieves. Have you seen that? Yeah. Yes. When they change, they go back because some of them have moved twice or thrice. Natoka hapa, akifika hapa, tunamuita mwizi. Akirudi, tunasema yeye ni mweupe kama paka. Akirudi huku, so it all depends on what you want. So the question is, huyu ni mtu ni mwizi ama si mwizi? Eh? Eh? See, it all depends on who is making the comment. Yes, that's what we mean by where you sit is where you stand. Kama ako side yetu, huyu ako sawa. Lakini akituacha aende ile side nyingine, we have a dosia. Akirudi, we don't due respect because these things are going on right. Sijuzi kulikuwa wanasema ati Wetangula anahama. So watu walikuwa wanasema sasa hatutakuwa tunasema ile mambo ya bibi. So you remember when he moved, the story was all those kind of things. Let me not go into interests and into details, but I don't offend anyone. But I'm only trying to illustrate to you that it all depends on where you sit or where you stand. And these things are used in corporates. And if you have not seen them, you will see them, especially when you start rising on the ladder. If your boss has an issue against you, atatumia ile method itakufinya kwa board na utatolewa. Na kama anakutaka, even if you are not good, atatumia ile method itakufavor. So if you are competing with your boss and maybe kuna project unaleta, na boss anaona hii ikisucceed, it will give you a better image in the eyes of the board. You will be preferred to be his replacement. Eh? So mkipelekana kwa board, your MD will just tell the analysts in the department, hiyo project inaletwa na Kimani, nataka mnipatie report mkitumia return on investment. So mimi Kimani naenda hapo kwa board na peana my report. Naye mkubwa wangu anakuja na report based on what? Nasema we have also been listening to Kimani, we think it's a good idea that he's bringing about, and we consulted our advisors, and here is the report. I don't know numbers not right. So ataambia the board members, sasa hii analeta ni ya 15, na sisi tuko 22 akatumisha. And the project is rejected. And the opposite is true. Kama ananitaka, ataambia watu wake wafanye report based on residual, na itakuja imepita. What should? You see now, who is presenting the two?
Let's say, for example, here, Mr. Kimani is presenting the board, saying that having evaluated the project on the other side, it can actually make us have this because based on the ROI, that we can residual income, we have this benefit. So we can actually evaluate.
So what will happen is this: one person cannot bring the two reports. Because if I'm the one pushing the project, I will go with the method that approves the project. So mimi nitakuja na residual income. Mwenye ananipinga Atakuja na, so kila mmoja wetu ako na only one report. You cannot bring two. You'll be accused of not taking, or you'll be accused of being indecisive. You must come with what? One. Now, when the two reports are tabled to the board, now the issue of qualitative factors decision making come in. And the question is, between you and your boss, who can the board trust more? A. Between you and your boss, who can the board trust more? So he's one to take the thing. So going to. And you know, the boss is always in the board. He's actually part of the board. You find that he's the secretary, he's the CEO. So yeah, wherever you are not part of the board, you are invited to make your presentation. So kabla ukuje hujui aliwaambia nini, ukishatoka hujui atawaambia nini. Even if you are also a member of the board, you are a member with less strength compared with them. So you still take the thing. That's why they say you must never outshine your boss. Follow his will if you want to benefit from it. Lakini ukianza kuleta projects in a compete, you might find it very difficult. Good. So that was a by the way. So I need to mention everything the question is required. We move. Okay. So we can do this one of the question that was tested in December 09. December 09, question 2B. It's on page 123 and 124. We're saying it's December 2009. December 2009, question 2B. That question is on what we call economic value added statement. Economic value added statement. Economic so we shall draw the table as long as we answer, even because of the interest of time. So hii column si mrefu, Amina is not wide. Even this one of the head office, don't give them a lot of space. Then hii ya kwanza inaitwa details. So these three deals go a bit wide. That is division A. We have division B. And we have division C. Now, economic value added, it is just an improved residual income. Your formula residual income, it is the same thing that we are going to use here. But now with some things we call accounting adjustments. We add and we subtract other items. So it's improved residual income. So those three things, the probability that we miss in any paper is one that is small. Return on investment, residual income, and EVA. Yes, yes. All of them are the same thing. You see, like now, I've already said that EVA is the residual income. And then again, for you to get residual income, the components are the same that you use to get return on investment. Okay, so we always start with what we call conventional income. Conventional income. Conventional income. When you see something being described using the word conventional, it simply means the usual or the traditional. So in this case, when we talk about the conventional income, it is the profit that we normally get from the financial statement when you're doing a financial reporting. And if you remember your financial reporting, the income statement, it has various items that carry the word profit. It has various items that carry the word profit. Like one of them, so now the income statement, tell me some items that carry the word profit. Because that's that knowledge is highly needed here. That figure, the name has the word profit. Profit of the year. Profit of the year. Which profit of the year? Good. Another figure, another name. Gross profit. Good. Another one. Net profit. Profit after tax. Retained earnings. Although I wanted the one that has the word profit as opposed to earnings. Profit before tax, profit after tax, profit before interest, profit after interest. Hizo vitu zote zinakuwa kwa income statement. Yes. So what I want you to know is that you can start here with any. So don't cram that yenye nitatumia hapa everywhere ndio inatumika. You can start with any, or I call the word what? Profit. Then the other thing is where you start, it should be clear in your mind what has already been subtracted and what has not been subtracted. So that when it comes to adding or subtracting, you'll be able to know what do I add back, what do I not add, what do I subtract. Yes. Now for this question, what we have been given, it is what they are calling profit before tax and interest. Yeah. That's why we don't write up and profit before tax and interest. We just call it conventional income because you can choose any. So let's now take division A, imepewa 28.5. B imepewa haina. Okay, I doubt whether. Okay, sawa. Basi haina 0. Then hiyo ingine ni 29. Na huyo mwingine ako na 9 points. Bado negative 9.6. Hii swali kuna a lot of typing errors. Because ukiweka 9.5, yeah, they should add back to the 76. Let me check whether I'll get the original. As typing errors. Let me beat the photo. I share in the group. Let me take another one. Okay, so I hope we are able to see it. And if you are not able to see, obviously I will write everything here. Have we seen it?
Yes.
Oh, you are not in a special group. Huh? A special division. There is even a Wi-Fi in a password. So we have seen it, eh? Okay, so if we have seen it, the profit before tax and interest is 28.5 for the first division. Division 2 has 28. Division C has 29. And head office has 9.5, which is negative. Now confirm whether they add back to 76. Yeah. Those who are online, I hope you have seen the question. Now, after you say conventional income, you bring the adjustments. The adjustments. The adjustments. In the adjustments, if you look at the notes, I gave you a list of items that you need to adjust and how. But in that list, you will never see anything to do with the head office. That one is taken to be obvious. That when you see something, yes, today I can see that. When you see something in the head office, you should share to the divisions. So the head office has a loss. So the first thing is the head office loss. The head office loss. Some questions, they will be very clear on how to share what is in the head office. Like this question is clear because you can see information 4. They are saying head office liabilities and net assets are to be shared equally between the divisions. But in the absence of that information, we always use turnover. You should use the turnover to share or to prorate. Sasa, your 9.5 divided by 3.
Sorry.
9.5 divided by 3.
3.2.
3.2. So hapa weka minus 3.2. Hapa weka minus 3.2. Hapa weka minus 3.1 because of the error, eh? Yeah, so that they go back to 9.5. Alafu sasa hapa unaiweka 9.5 positive so that it cancels. From there, you check whether there could be other items that will require adjustments. When you look at information 1, you can see division A spends 10.5 on research. Now research must be added back. So I think a research should be added back, and it is in division A 10.5. And then you record it book of mission for the company 10.5. 10.5. Information 2, it has goodwill. Goodwill should be added back. So we come to goodwill. Goodwill it is in division B, 90. And division C, 113.5. And when you add them, you get what? 203.
Yes.
203.5. We should go back there. Advertising should also be added back. Advertising should be added back. And it is in division B, 11.5. And then you bring it here, 11.5. Then we have the summary of the interests. The interest received and the interests paid. Now, interests, we say, should be added back. But where we have begun, they have not subtracted. Because we have begun with profit before tax and what? Interest. But if we began with profit after interest, then you should have added it back. So the interest will not affect us, both received and paid, because they have not been deducted. Borrowings, that is part of capital. It's a long-term liability, eh? So that is not supposed to appear in the income statement. So na hakuna tax. Yeah. So with that now, we get a figure called revised income. Revised income.
This is the reverse of our income statement. There's no money.
Is that?
It is the reverse of our income statement.
Because normally
We less the expenses to get there. We see the non-interval you add up the expenses that we are doing the reverse way.
yeah, it could be said to be the reverse, but I don't want to use the word reverse. I want to use the word adjusted. Yeah. The adjustments, let's see whether I have some time. The adjustments are like this. In a FAR, they deduct these expenses. And they purport to use something we call the periodic concept. Periodic means the costs incurred in this period should be charged to the income statement of that period. But they fail in a concept we call matching concept. Matching concept says the revenues received should be matched with the costs incurred to generate those revenues. So the big question that should be based and answered in preparing in the statement is, these costs that I have spent today, will it help me beyond today? If the answer is no, the whole of that cost should be fully charged in the income statement of today. But if the answer is yes, then that cost should not be charged fully in the income statement of today. It should be taken forward. For example, you people, you have incurred a cost called tuition fee. So now this quarter. So let's argue in terms of the quarter. The first quarter of 2022. In your income statement, you out of 22,000 in your Melipa school fees. The question that we need to ask ourselves, your 22,000 Melipa, is it already beneficial to you from January to March of 2022, or it will have some benefits beyond March 2022? Will it have any benefits beyond March? Now, if yes, then you should not fully write it off in your income statement of January to March. Unastahili kuigawa. Some zimekusaidia this semester. So ile usaidizi umepata uweke hapo. Ile usaidizi utapata after that, nayo upeleke, you prorate. Is it now making some sense? Yes. So management accounting comes and says that what YFR who are wanakosea, they don't give us the true picture. Because ukiuliza mtu wa YFR atakwambia hii masomo ime cost 22,000 this semester, which is very expensive. But ukweli ni kwamba hii masomo ime cost kitu kidogo sana. Because it will help you actually forever in your life. So if you estimate from now, utaishi miaka ngapi, unastahili kugawa hiyo 22,000 kwa hiyo miaka yote. Sinaona ni pesa kidogo sana? Yes. Why not? It is. It is. Hii masomo itakusaidia, actually itakusaidia even beyond you. Because those who come after you, they will enjoy the wealth you have created. Yes. That's why they say, if you think education is expensive, you try what? Because education is so cheap. So cheap. Even itakusaidia miaka yote.
I'm saying in front of the 22,000, you can't share it like when you, okay, yeah, you can't share that expense.
You can share, or even if you don't then share, at least in your understanding, you don't perceive it as very high. Yes. You don't perceive it as very high. And when you don't perceive it as very high, you are encouraged to look for the money and pay. But when you perceive it as high, even when you don't have money, or even when you have money, you won't pay. That's where the management accounting comes in. Okay, good. Higher. Now, nipatie hii that 5.8. Huh?
And 26.3.
Toto hapa. You're 1.5. What I'm explaining is the reason that makes people, because you work in accounts, unakazia watu wa marketing. You don't want to give them money. Because the accountant wants, nimekupea hii pesa, hii mwezi, where are the results? But the marketer, if they're advertising, the results may not be immediate. They can even be 5 years. So you'll always find there is a struggle between the accounting department and the marketing department. Because the accounting want to see the results. Where are the results? So that is okay. Then we go to conventional capital. Conventional capital. You know, I do marketing, and I know marketing in when there is a surprise. Okay. Does it happen that way where you are?
Yes.
Marketer anapewa pesa kama imebaki. Yes. But not the first priority. But the truth is supposed to be the reverse. Marketer ndiye anastahili kutoa pesa kwanza. The others can wait, including mishahara ya wafanyakazi. Sasa, the next thing is now the conventional capital. You see now hapa ninatumia the word capital. Kwa hiyo swali lingine tulikuwa tunajibu tulitumia the word assets. Yeah. Now these assets or this capital ni hii wamepeana hapo, total assets less current liabilities. We are on 135.5, 119.5. Huyu mwingine ni 116. Na huyu ako na 16. Total ni 387. Then we do the adjustments. We do the adjustments. As I said, the very first thing is if there is anything in the head office. So the head office assets. So this head office, we advise that we share equally. So 16 divided by 3. 5.3. So hapa weka 5.3 Upper 5.3, and this one then should be 5.4, eh? So that they add back to 16. You are negative. So that's going to make 12. These adjustments, they also come here to the capital. Because research is supposed to be, YFL, research is a current expense. But here in EVA, we say we should capitalize it. So when you capitalize it, it goes to the balance sheet or to the statement of financial position. So research, this is 10.5. Na tunaiweka huku mwisho 10.5. Aya, huyo mwingine ni Goodwill. Goodwill, it is 90 and 113.5, total to 3.5. Hiyo ingine ya advertising, it is 11.5 here and 11.5. The other item that should come there, although it will not come, is borrowings. Now, borrowings from your FR, is it a current liability or a long-term liability? It's a long-term liability. So if it's a long-term liability, it's already included here. Because what you have brought here is total capital, less current what? Liabilities. So the long-term is covered. So you don't bring it again. It is because these things will find their way in the balance sheet. You know, when you're making a financial statement, we have the income statement, and we have the statement of financial position. There are some items that move from the income statement and they find their way to the statement of financial position, and others do not. So in FR, these ones, they will not find their way because they are treated as current expenses. Current expenses. Even at times, Goodwill at times can find its way as an intangible asset. But it's also very tricky because it is usually written off. So it may also not find its way there. Now we are saying that is an error. Let me explain something like this. Goodwill is the amount of money you pay in excess of the realizable value of the assets. Like ukinunua biashara kama hii. Hizi viti, the amount of money you can fetch, tuseme you can sell them at 20 shillings. So utanilipa 20. But me hii biashara itakuuzia 40. Ama tuseme 35. So the extras 15, this is called Goodwill. From your FR, you know, we don't have a single method that is agreed upon of charging. That's why as soon as we recognize it, because it is there, you immediately write it off. So that those who will come after you, you cannot easily explain. That's the reason why. Immediately you recognize it is written off to avoid questions that will follow subsequently. Now, some factors that contribute to goodwill include location. Number two, the employees already company gonna workers who are already experienced. Na nikikuuzia biashara unawachukua, si ndio? Hii biashara iko na customers. Nikikuuzia hii shule utakuja ufukuze wanafunzi useme nyinyi yote mlikuwa akimani pekee kabisa natafuta wangu. So you continue with them? Yes. Now, if you continue with this location, if you continue with the workers I have, if you continue with the customers I have, It means you are enjoying benefits from that goodwill. That's all. Next semester. But now you already have written it off. When you write it off, you are telling us there are no benefits. But the truth is there is what? Benefit. So FR then it is erroneous. It is erroneous because inatuambia hatutapata goodwill. Hii biashara hutahamisha hapa immediately upeleke River Road. Hutafukuza kila mtu. Yeah. So the correct position is you need to bring it back. That's why tumerudisha hapa kwa profit na bado tumerudisha hapa kwa capital to be recognized as an intangible asset. And the same argument goes for the others. Yeah. But for the exam purposes, I'm not to send your exam. So I was at the point of saying borrowing should come here, but they are already included. That's why I told you where you begin, it is important to do a mahali mmeanza, who has been subtracted, who has not. Ndio ujue nani utarudisha, nani hurudishi. Yeah. So let's get the revised capital. Revised capital. Hii inatoa ngapi? One 151.3. Hmm? 226.3. 234.9.
612.
So let's now get to the cost of capital. Cost of capital. Cost of capital. So cost of capital, we are told it is 12%. So utakuwa unachukua this one, you multiply by, so kama hii sasa utasema ni 0.12 times 151.3. %12% of the revised capital. Don't round up, give me now the full figure. 156. I do the same, give me 12% of this. Hmm?
27.156.
Huh?
28.188.
Na hapa mwisho 17. 3.5. And then we come and get EVA, economic value added. So economic value added, EVA, it is, you take this income. Remember I told you that EVA is the modified residual income. We could book a formula residual income, what to say by income minus the cost of what? Capital. So sasa kama hii tunaweza andika working, it is 35.8 you minus 18.156. $644. 17.644. I do the same. Where the pale kwa 126.3, you less 27.156. 99.144. Huyo mwingine? One point 212. Na huyu wa mwisho 228 exact, eh? Okay, that is how you compute EVAT. Now, let me make a few comments. One, performance measurement is an exercise where we come to compare what you have done vis-a-vis what you were supposed to have done. And the difference is the variance. It's called variance, what we have been computing previously. That variance we know can either be favorable or adverse. If you report a favorable variance, you are supposed to be rewarded. If you report an adverse variance, you are supposed to be punished. Yeah. Now the question is, how do we measure responsibility? Like when I'm in this class, because I'm now the manager of this class, the divisional manager of this class, how does the school measure my responsibility? On which aspects should I be punished or should I be rewarded as far as this class is concerned? So in trying to answer that question, our company is divided into 4 areas, which you can check responsibility. One is called revenue center. Now, this is where you only judge the manager on the basis of revenues. Sasa ukiangalia hii swali yenye tunajibu, can you see the sales? Naona hapo kuna sales. Now, A has 408, B has 316, C has 1159. So if this was being appraised as a revenue center, which manager will be declared the manager of the year?
A.
Is it A? No. C. C has 1159. So that's why those are the fellows you hear in companies being referred to as sales managers. So yeah, anapimwa based on sales. The second way of measuring performance is investment center. In investment center, you simply check the capital that is in that department. So ukiangalia the assets, you can see one A has 135, huyu mwingine 119, na C akona 116. So who imagines the best manager there? A. The A. Yeah, so you see again, we have a different now manager. The other way you can measure performance is in terms of the costs. So here you appraise the manager based on how much cost they have spent. Not saved, when you call it saved, it is profits. It is how much they have spent, the total cost. That is what we look at. Sasa hii swali haijatupea cost, so we cannot be able to mention who is who. The last way is profit. Now here, you look at how much profit the manager has made. And as I said, in the income statement, there are various items that contain the word profit. But in most cases, we use the net profit. So ukitumia hii, the manager who will be declared the manager of the year is this one, followed by this one. This will be manager 3. But when you use IVA, manager number 1 will be C, followed by B, followed by C. Sorry, followed by E. Now, according to management accounting, this is the best measure. That is what you should be appraised for. And they argue this. For this manager, ukitumia hii convention na utumie IVA, is still emerging number 1. So hiyo tunaachana nayo because it is common. Our focus now should be here. Whereby ukitumia hii convention, huyu anakuwa number 1, huyu anakuwa number 2. Lakini ukitumia IVA, huyu ndiye number 1. Sivyo? Sasa, the issue is this. When someone does something, they don't need to be told. They know what they have done. There is an inbuilt mechanism that tells you whether you have done right or you have done wrong. Whether umejulikana ama hujajulikana, whether umeambiwa ama hujaambiwa. Like now when I teach you so well, you don't have to tell me. Like I don't think this semester I'm going to unwind my response. Don't have to, but I know. Equally, nikikuja hapa niwafunze niwadanganye. Nyinyi hamtajua. But me as I leave this door, nitajua hapo hao watu niwadanganye. Na kitu nimekosea lakini hakuna mtu anajua. So you know it. That's the first point. Now, the point is this. This guy is a good performer. Naona akona 99 compared na huyu. Now you ignore him, you promote the poor performer. This guy will fight back. And from motivation theories, you come about leadership and management. You must have been told that recognition is a basic human need. And when denied, it will be sought for. Fortunately, most of you are ladies. When you go to the salon and you come to the house in the evening at around 7, and the people in the house, good, they appear like they are not noticing. Watu hapo wewe TV tu naona. You want to new style. Utakakaa ikifika by around 9, utasikia tu kaswali kameulizwa kidogo. Yani muone. And that's a very difficult question to answer. Yes, that's what we are saying. When you deny recognition, it will be sought. And unfortunately, or fortunately, what you are not ready to offer, someone else is ready to offer. If you don't recognize me, hapa nje kuna mtu ananigoja and recognize. Let me confine myself to a company setup. In a company setup, if my company does not recognize me, there is another company that is ready to poach me. That's when we hear of poaching. So watanikujia, nitaenda. Yes. Na kama si watu watanikujia, mimi nitajitoa niende nianzishe yangu pale. And we have many examples including testing. I don't want to go into that. Na nikishajitoa nisimame pale, chances are nitakutoa. Because mimi ndio nilikuwa unaona kama saa hii mimi ndio niko na nini. Si principal ako na nini. Sasa nikiwaambia nimefungua class kangu kako pale. Nitafuata tu. So principal ataachwa akishangaa hawa wanafunzi wako wapi. So that is the danger of not using EVA. You are likely to lose the good employees. Yeah. So time is over. So we call it at that point. We pick up from there on Monday, which should be our last lesson.